Hello and welcome to Management Accounting Applications. Today we are going to look at marginal versus absorption costing, and it will be presented by Dr. Martin Roberts. So where do we start? I think the best place to start is marginal costing. It makes the income statement very basic, but is very powerful in its decision making, and as I mentioned there, is that you'll see the use of marginal costing in programs about business such as The Apprentice and Dragon's Den, and is very simple to use. So in terms of just familiarizing yourself again as to quite what marginal costing is doing, is that if you take an income statement, is that what it's doing is it's doing sales or turnover or revenue, which is multiple units by a selling price, less cost of sales, but purely variable costs. Okay, examples of variable costs are all listed there. So direct labour or wages, materials, logistics, and anything else that could be deemed variable. And then what you do is you generate enough contribution to contribute and cover your fixed costs. And hopefully at the end you'll make a profit. So again, there it is, just to really make the point, is that there you go, is that you make enough contribution to cover your fixed costs and you will break even. Okay, now then, what we've got a problem with as we move from marginal costing to absorption costing is that the problem is that you can't use marginal costing techniques when you're presenting your formal accounts. Okay, you must have proportion of production overheads circled in your stock valuation, and that's according to International Accounting Standard number 2. That's one of the very basic premises, is to give a true and fair view of your inventory or your stock valuation. Then you must include a section of production. Okay, so to keep it simple, there's a bottle of water, and under a marginal costing basis we would cost that individual unit, that bottle of water, by how much material goes into one, how much labour goes into one, and any other variable cost. Now, what then happens is that under absorption costing, what we've got is we have the same unit cost for the water of materials, labour, and anything else that's variable, but this time, because of law, of statute, we must add an OAR, which is an overhead absorption rate. So how an overhead absorption rate is calculated, you will have been given this in your first year, and if not, here it is again, is that it is in essence your budget production overhead. So that production cost that you saw circled is then divided by a budgeted base, and the key word is budget. Is it's set once a year, and we'll deal with that as we move along. Okay, the thing to notice is that the base can be anything, okay, that is applicable to the volume of the units passing through your factory. Okay, so that includes units, so how many total bottles of water were made, how long did those bottles spend on the machines, or even if it's a more manual based production, how many labour hours are used to create those units, or sometimes it can even be things like prime cost as a basis of your OAR, although that's very rare and will lead to probably inaccuracies in your unit cost. It's mainly the first three that you will see. Okay, so for example, there we go. We have £1 million in overheads, we have 1 million units that are budgeted to be produced, and so therefore our overhead absorption rate is very straightforward. It's £1 per unit. So in essence, what happens is if that water bottle costs £1 to make in terms of your variable costs, then you add the £1 overhead rate that you've created, and so forth. So therefore, your total cost is now £2 per bottle. Now, what that leads to is what's known as full production pricing, and what that means is that you've got all your variable costs, your prime costs of the factory, plus your production overheads. So what that means is that when you set prices, you've got confidence that you've covered all your costs, and hopefully you can add a margin. Okay, so in terms of where your understanding is tested, is it's really in the income statement and the comparable effects you have when preparing either an income statement on a marginal costing basis or on an absorption costing basis. So, like I said earlier, is that the problem is you only set your overhead absorption rate once at budget time, hence the term budgeted cost divided by budgeted base. Okay, and like my note says, if you constantly adjust for every time your overhead fluctuated or every time your volume fluctuated, you would have very difficult problems in understanding your movement in your income statements, your profit and loss. You'd also have problems probably trying to understand on your balance sheet side, your inventory and your stock valuation. So we don't do it. We adjust for it at the end of every year. Okay, so if you look at a marginal costing income statement, it's incredibly straightforward. So it's simply sales, that's your cost of sales, gives you contribution, okay, and then what happens, less your fixed costs, hopefully will give you a profit. Now on the other side, what we've got in bold is where we need to really pay attention. Okay, so what we have sales. That's our cost of sales. Now our cost of sales will include a variable cost per unit plus an OAR, budgeted OAR, and so therefore there must be an adjustment in your income statement for what actually happens in the month or in the year. So what you do is, in essence, you compare the two halves of your OAR calculation. The first one's incredibly straightforward. Okay, and you just compare your costs. You had a budget cost of say £1 million, and your actual would be say 1.1. And if you spend more than budget, it's bad news. Okay, and that's the one thing to remember with this, is that it's the other way around to how you normally speak. If you say I've spent more than budget, you would say you're overspent. In this case, you have a variance whereby you've underspent. It's still bad news. Okay, and so what you then do is probably the trickier bit to it, just because it's got another thing to do, is that another stage to do, is that you compare volumes. So our volume was again say 1 million units. So again here, if we did 2 million units, then we'd have good news. Now that good news needs to be multiplied and put into pound value by multiplying it by the OAR. So your variances here will that's just simply, the top one is just simply a comparison of cost. This one is if we have 1 million units where we've produced more, we times it by the OAR of £1. So therefore we have £1 million worth of good news to show into the income statement, and this time, because it's good news, we've made more with less cost, or we've made more at the same cost, doesn't really matter, is we've made more than we expected, then we have over absorbed. It's good news. Okay, to repeat, if we spend more than budget, we have under absorbed. Yeah, it's bad news. Good news, over absorbed. Try and get that in your brain if you can. What I always say to you and try to make you all laugh when you're in lectures, which unfortunately we're not, is that when you're out on a night out, you have a budget of say £30, and if you spend 40, you don't wake up the next morning and say you've overspent. You have underabsorbed, and that's how you must talk to your friends moving forward. As you've had a bad night out, you spent more than you thought you have. I've underabsorbed. You'll end up with no friends, but hey, you're going to be accountants anyway. All right. So the other thing to notice is your production overheads have gone to zero in this particular example. Your production overheads and marginal costing has stayed there, but this one is at zero because you've used and adjusted for it up here in your OAR calculation and adjustment for actual versus budget. So that's another thing to remember. Okay, so moving on. The good news is even though that seems very complicated, is that you can actually check your work, certainly at level 4s and 5 when we do this, because it's very simple. You create, using various bits of data, you create a marginal costing income statement, and you create an absorption income statement, an absorption costing income statement. And so the good news is that you can actually check the variance between the two. So here you go, just to make it nice and simple, is that the marginal profit that you end up with and the absorption profit that you end up, there will be a variance, and it will be a certain amount. And so how you check that is you look in the month or in the year, whenever the question's set, you look at the actual units versus the production units. That will give you a variance in volume. Again, you need to give it a value, so you times it by your OAR. And then what happens is you will then create a value on the difference on that movement in stock. If those two numbers are the same, then your calculations are spot on. And if you say got this in an exam question, you will be able to be very pleased with yourself because you know you've got full marks. Okay, so the last slide is just around how OAR is used in the real world, and it's all about motivation. So the way it works is that there's the original OAR calculation that we had, and then if we can, as accountants, try to say decrease our costs, which is what you'd ask to be do, is create a saving, and we still had 100,000 units as our production, then our OAR decreases. It's good news. And then the second time is that if we increase our volume and our costs are still the same, here's the good news that I was talking about earlier, is that that's why it's good news, because you've reduced your OAR by 50p. So what you're trying to do, you're trying to get your costs down, you're trying to get your volume up. Okay, and if say we were 50p as our new OAR and we kept our variable costs at £1, then therefore what's happened is that we've reduced our costs by 50p. If we're able to keep our prices the same, we've increased our margins. So what you'll see is this is used an awful, especially the volume one, is used an awful lot in manufacturing, an awful lot, and very apparent in car manufacturing. So that's why if you're very lucky enough to go get to go to any car sales dealership, is that they will almost a month end and a year end and a quarter end, they'll always want to give you a bargain because there is a push from the manufacturer to get as many units out as possible. Okay, so I'm going to leave it there. I hope you've enjoyed it, and any more questions, don't forget to send me an email on martin.roberts@shoe.ac.uk. Okay, take care and goodbye.